it is only charged by taxpayers who are registered for VAT only. There is a threshold to who is supposed to register and charge VAT. So any person who supplies or expects to supply taxable supplies, goods and services of a minimum of 5 million and above within 12 months, then that person is required to register within 30 days from the date he becomes a taxable person. So registration of VAT is done online through the iTax portal. I'm sure everyone is familiar with the iTax portal. And monthly returns are to be filed electronically every month. And you don't need to visit any KRA physical office unless you have challenges filing those returns. After filing, payment is done through mobile money, M-Pesa, and any other mobile money wallet using a payment registration number. And that payment can be done at the comfort of your wherever you are. Goods and services are classified in two main categories. There is exempt services, goods or services that do not attract any VAT, and they're listed in the VAT Act first schedule. Part 1 is exempt goods and part 2 is exempt services. And these mainly are food items, medical and agricultural supplies. And most of these items, depending on the policy of the government, is usually amended on a yearly basis through the budget that is read by the CS Treasury. And then there's a taxable supplies, which we normally say it's vatable supplies. They are subject to VAT, and they are not listed in the first schedule, that is the exempt schedule. So if you are to try to know which goods are actually taxable, you will need to do an exclusion. So you'll just go through the first schedule. If your goods or services are not listed in that first schedule, then they are automatically vatable. So then if you're in the business of doing those kind of supplying of goods and services that are not listed in that first schedule of the VAT Act, then you are required to actually charge VAT on those supplies. And VAT is VAT rates are three types of tax rates. That is a zero rated supplies, and that is at 0%. And then there is 8%, which is usually petroleum, oil products, motor spirits, and these kinds of petroleum products. And then there's 16%, which is the general rate for other goods and services, which is mostly common to all other services, other than the 0% and 8%. An example of zero-rated supplies is an export of a good. For example, if you're exporting goods outside Kenya, then those goods are going to be zero-rated supplies. So meaning a 0% of VAT is going to be charged on the supplies. Similarly, if you're making supplies to an EPZ or an SEZ or a privileged body that is mentioned in the VAT Act, such supplies are going to be zero-rated. Then there's the exempt supplies, which include the educational services, medical services, burial services, financial insurance services, including insurance brokerage services, and then transportation of passengers except where the means is hired, chartered, or international transport. And the tax point or the time of supply for transaction is the date of transaction, the date the transaction takes place for VAT purposes, and this is clearly defined in the VAT Act. It is the earlier of either, as you are seeing on the screen, Roman 1, Roman 2, 3, or 4, the earlier of either the date of the issuing of the invoice, date of delivery of supplies or performance of services, and receipt of payment in part or full on account of the supplies made. And then the earlier of a date of a certificate issued by an architect. So those are the tax points at which VAT is supposed to be charged. Then the operations of VAT is on input and output principle. That means if you are
Hello, Mohammed. Just a quick one, right? On your slides, are you presenting? Because we're just on the first slide still, I think, for all of us. So,
oh,
yeah. Yeah, so I think from where you left off, I think you can show us that slide as you move on, right? I think for visibility for all.
sorry for that. Let me just try to. I don't know if it's the network.
Maybe you can just, I think it's not the network. It's if you're on slide, let's say 10, just go to slide 10. Try that and then we can move on. Perfect. Yes, we can now see them moving down. Mohammed, you can continue to where you left off.
Oh, I think couldn't be able to go to the next slide because of the, I think, slideshow. So I'll just leave my screen there it is. I hope it's clear. Maybe I just increase the size.
Yeah, that's perfect.
So I was saying VAT operations is on an input-output principle. That means if you purchase goods in the course of your business, and you purchase these goods from a person who is registered for VAT, then those goods are going to be subject to VAT at 16%. And the sales that you're going to make is assuming you're in the course of business, you're not a final consumer, then the sales that you're going to make is going to be inclusive of VAT. So then the VAT payable is going to be the output tax, that is the tax on your sales minus the input tax, that is the tax, that is the VAT on the purchases. So if the difference is positive, then you're going to be having a tax liability that is due on or before 20th of the following month, assuming the return that they're filing is for the month of January, then the tax due is going to be on or before the 20th of this month, that is February. So if the result is a negative, that is a credit, then it means you are going to carry forward that credit to the next month, and so on and so forth. So that is how VAT works. Coming to digital services tax, it's a new tax that was introduced it was effective in January 2021. And I think most of you who are operating on digital platforms must be aware of this, assuming you've been following the news in terms of the taxation of the digital economy. So any person who derives or accrues income from services through a digital marketplace is going to be subject to this tax at the rate of 1.5% of the gross transaction value. And this DST tax was previously applied to both residents and non-residents, but through the amendment of the Finance Act 2021, this tax was removed from residents. So residents currently are not going to be are not subject to this digital services tax. So going forward after July 2021, DST is only applicable to incomes of non-resident persons who don't have a physical office in Kenya. So yeah, similarly to VAT, the person is required to submit a return and pay the tax on or before 20th of the following month. And applicable to residents between January to June 2021.
Just a quick question.
Yes.
Would you come back on that resident and non-resident of DST?
Yeah, thank you, Blackjack. Right. I think we'll take the questions at the end, right? Because I know there are a couple like on the digital service tax and a couple. Let's just first finish the slide, and then after the session, right, we'll ping all the questions, because also us on our side we have questions, like it's so that we can absorb all the information.
Thank you.
Yeah.
Yeah. So I've noted your question, and I'll just go through the DST once again. So DST was introduced in January 2021, and it was effective from 1st January 2021. And it was applicable to both residents and non-residents between January and June 2021. It is only applicable currently to only non-resident persons who supply digital services in Kenya. So I think that was the clarity that you're seeking. But if you have any queries, I think you can have a question at the end of the presentation. This is the supply chain of VAT. Ideally, manufacturer of a good or a service is the originator of, for example, the first person to charge VAT. And then there's a wholesaler, a retailer, and a consumer. So the first three are not are registered for VAT, but the final consumer is not registered because they are the final consumers, and they don't use whatever service or good they buy in their business. So they are deemed not to be registered for VAT. So just an example of how a transaction works. transaction without VAT, and then a transaction with VAT. So you can see there's a buying price of 100 and a selling price of 200. The gross margin is 200 minus 100. This is 100, and that is a transaction that doesn't have a VAT. So the second transaction is the same buying price, but inclusive of VAT at 16%. So the VAT payable, as I explained earlier, is going to be the output tax, that is 200 times 116%, that is 232, and minus 116. So the VAT payable is going to be the difference. In this case, it's a positive of 16. So in the case where it is a negative, then the negative is, the credit is going to be carried forward to the following month. Withholding VAT, in the process of accounting for VAT in Kenya, KRA is mandated to appoint withholding VAT agents, and it's not everyone who is a withholding VAT agent. So maybe in the course of your business, you've come across a VAT withholding certificate. That is because you did business with a VAT withholding agent, and the VAT withholding agent is required by law to remit a percentage of the VAT to the government, that is through KRA. And that is just an accounting mechanism that KRA has used to actually know how much VAT is out there. The current rate is 2% of the value of the taxable supplies, and that is effect from 2019 November. VAT refund is on bad debts, and this needs to be applied to the commissioner. And after the period of 3 years from the date in which the supply was met. And then there is also a VAT refund on VAT that is paid in error, and excess credits as a result of zero-rated supplies, as well as offsetting of credits arising from withholding VAT. This is the VAT due date and penalties. So the 20th of the following month, and then there's a 5% of tax due, or 10,000, whichever is higher, when the filing is done late. And then there's also a 5% tax due on late payment of the tax, and an interest of 1% per month of the tax due. I think I can invite Elizabeth, as maybe Elizabeth is joining. I don't know if Edward, you can take a few questions, or Elizabeth will just go on with the presentation first.
I think it's better if she goes on, and then we'll leave the chat open for a couple of minutes, because we have already the questions at hand. So she can take us through, and then any questions, we'll put it, right? Because we already received it from the email that we sent to us, the vendors, right? So if you have any questions, please flag on the form, and then we'll be happy to put it on the chat.
Hello. I can see the chat is inactive. For sending messages.
Okay, good afternoon. Please confirm whether you can hear me.
Yeah, we can hear you.
Yes, we hear you.
And you're able to see my screen.
Yes.
Can you see my screen?
Yes, we can.
Okay, I'll start.
I think for the people who are not able, just to give context, for the people who are not able to see her screen because it has changed, you need to pin Elizabeth's screen so that it gives you a pop-up view.
Okay, can I continue?
Yeah, you can continue.
Yes.
Okay, good afternoon to everyone. Okay, the presentation, we have divided it into two. Kasim was called VAT and DST. Then I will be taking you through income taxes. So we'll just start. So in Kenya, businesses are either registered as sole proprietorships, partnerships, or companies. And all these businesses are expected to pay their income tax or to have that income tax obligation. That is in addition to the VAT obligation. So income tax in Kenya is guided by our Income Tax Act, which is Cap 470 of our laws. And income for tax purposes arises where the business is carried on wholly in Kenya or partly within and partly outside Kenya. So if you have a business in Kenya and you're operating it, part of it in Uganda, then we'll expect you to declare that income for purposes of tax. Then we have...
I'm sorry, madam, but we can hardly see your screen, eh?
You can't see my screen?
No.
Yeah.
Now, will that... I really don't know, because I've shared and
just-
it's even I'm sharing.
Yeah, Tabitha, I think Nipstar and Mavazi, what you need to do on your screen, right? You see Elizabeth's presentation, there are like three buttons, right? So you go to say pin, let's say Elizabeth's now, and then it will pop up the presentation. Just try doing that and then let me know if
I have,
it
and
works.
it is still not showing.
Same case. It's pin, but
because-
it's not showing.
you
Pin, but
can
it's not showing also.
on Elizabeth Mwambingu's presentation, right?
Yes.
Top line says it's okay. We can see. Okay. So is everyone good now on the presentation? Can be able to see from the pin.
No, I can't.
If you're using a phone, right, just tilt it to the side, right, because it could be now the screen size, right? Tilt it to the side so that it's on landscape, and then you'll be able to see. And then I'll ask Elizabeth, can you just increase the font size a bit? Yeah, yes, top line. Thank you. You need to pin, right? Like go to Elizabeth Mwambungu's name, right, on the people there and click pin. Yeah, that's enough. Thank you, Elizabeth.
Okay, I start from the beginning. So we
Yeah.
have said that businesses in Kenya are registered either as sole proprietorships, partnerships, or companies. So the sole proprietorship, that's an individual in business. Partnerships is where we have two or more individuals or partners in business. Then a company, we have what we call the artificial person. And the taxation of business income in Kenya is guided by the Income Tax Act, which is Cap 470 of our laws. Then for purposes of income tax, or income tax arises where business is carried on wholly in Kenya. So your business is in Kenya only, or partly within and partly outside Kenya. So if you're trading in Kenya and any other place, then we require you to have that obligation. So we talk about tax regimes, and these are the manners in which you can report your income tax. So we have the turnover tax regime and the annual regime. So we shall go into details about each one of these. So we start with turnover tax. This is tax that is charged on gross sales of a business, and it is covered under Section 12C. That's capital C, 12C of our Income Tax Act, and it is payable by resident persons whose gross turnover is between 1 million. Okay, it starts from 1 million shilling. It's more than 1 million shillings, but not up to a maximum of 50 million shillings. Income, okay, and then we have certain income tax, certain incomes that are not allowed to register for this obligation. So if you're a person with a business of income that is below 1 million or in excess of that 50 million, then you're not expected to have this obligation. Rental income, then we also have income from management, professional or training fees, and any other income that is subject to withholding tax. An example of such income is like interest. When you earn interest from the bank, tax is deducted at the bank, and we say that that tax is final. So we don't expect you to declare that again. So the annual income tax regime. So Section 2 of our Act defines business income, and this is any trade, profession, vocation, every manufacture, adventure, and concern in the nature of trade, but it doesn't include employment. So where you have, as we earlier said, a business that is carried on partly within Kenya and partly outside Kenya, then the whole of the gains or profits or the income from that business, we deem it to be income that is accrued or derived from Kenya. Then the annual tax regime is based on the accrual system. Now, in this accrual system, you report transactions as they occur, as opposed to when you receive payment or when payment is made. So if I sell something today and I get payment, let's say after 3 months, I will not report it when I get payment. I will report that transaction today because today is when I sold. Similarly, if I make a purchase or I incur an expense, I will report it when the transaction occurs as opposed to when I make payment for that purchase or for that expense. The final tax payable is reduced. So for income tax purposes under the annual regime, you compile all your transactions for the year, prepare your accounts, and then come up with your tax. So when you come up with your tax, we have some of these taxes you've paid in advance. Like we have advanced taxes for people in the transport sector. We have installment taxes for people with businesses. You're expected to be paying your installments. We shall discuss installment taxes in brief. Then we also have withholding taxes. So you provide a service to someone, and then they pay you part of the money and they withhold part of that tax, but they will give you a certificate showing that an amount of tax has been withheld from you. So when you're declaring your taxes at the end of the year, these taxes that were paid in advance will be deducted, and I'll take you through our example to just like help you picture how it is done. So in determining taxable income, we allow expenditure that is wholly and exclusively incurred in the production of that business income. And we do recognize that not in all cases you will end up with a taxable profit. So in some cases, you might incur more expenses than the income, in which case that will be a loss. So when you make a loss, you are allowed under the law to carry forward that loss. So you will offset that loss from your future business income. So if I make a loss of, let's say, 100 today, in this year, then next year I make a profit of 300, then the law allows me to deduct that 100 loss and then tax the 200.
Excuse me, Madam Elizabeth, kindly work on this. Oh, thank you.
What is wrong with the slides? Hello? Kindly confirm if you can see the slides.
We can see.
Slides.
Okay, so Jerry, what you can do, right? So let me just give, because we're getting a lot of charts on this, right? On the side, right, there's something called people, right? There's like 100 people, right? Like there's an icon for people, right? You need to pin the one called Elizabeth Mwambingu presentation, not the first one, right? The first one is just the voice, right? The second one is the one that has the presentation. So if you click on that and pin it, you'll be able to see. Okay? So you click. Try that. Yes, right? I think everybody is using Elizabeth's first icon, which will show you an E. That's why everybody is getting that error, right? I think the rest have been able to do it. So it's the one called the second one, Elizabeth Mwambingu, and then it has in small presentation. Let me know if you're able and everybody else. before we move on. Thank you,
All right.
Ellie, for confirming you can see the slides.
Thank you. I can see the slide now.
Good stuff. Thank you, Elizabeth. I think you can start with the slide for annual tax regime.
Thank you for that. So we have talked about installment taxes, so we go into a bit more detail about installment taxes. So to get your taxable profit, you take your income plus what we call allowable business expenditure, which in our previous slide we have defined as expenditure that is wholly and exclusively incurred in generating that income. So we file tax returns through iTax, and that is by the last day of the 6th month after the end of the accounting period. So as we said, you compile your transactions for a certain period under the annual regime. This period is what we refer to as the accounting period. So it is the period for which you will make up your accounts. So the law guides us on accounting period. For individuals and partnerships, we've been given a December date, 31st December. It's default for individuals and partnerships. And this return should be filed by 30th June of the following year. So for example, for the 2021 accounting year, which runs from 1st January to 31st December 2021, we expect that the return will be filed by 30th June 2022. Then for companies, or these are the incorporated persons, they are allowed to choose a date that is not December. So a company can choose any other date. It can go with December or choose any other date. So for example, a company that has 30th April as its year end, it will file its return on 31st, by 31st October of the same year. So if it is 30th April of 2021, that is the end of your accounting year, you count 6 months. The end will be 31st October. So anytime between now, 1st May and 31st October, you can file your return. So we are talking about installment taxes. So I'm taking you now through an example of installment taxes, let's say for the year 2022. So in 2021, we assume your profit was 100,000. So according to our laws, to determine how much you'll pay as installment taxes, you take your previous year's tax liabilities. So in 2022, we'll take the tax liability for 2021, which in our example was 100,000. You increase the previous year's tax liability by 10%. In our example, we get 10%. Then we divide the installments. There are usually 4 installments. So you divide that amount of 110 by 4, you get 27,500. And the law guides that installment taxes should be payable on or before the 20th day of the 4th, the 6th, the 9th, and 12th month in 2022. So in 2022, we'll expect that if it is a December year end, we'll expect that in April, in June, September, and December, you'll pay us 27,500. Then that is on or before 20th of April, 20th of June, 20th of September, and 20th of December. Then when you come to the end of the year, 2022, and you find that you made more profit than what you've paid as installments. So for example, now in 2022, when we are preparing our accounts in 2023 for that year, for the year that ended 2022, we find that our profit came to 900,000. Then we shall be required to pay what we call balance of tax. So from our tax of 900, we had paid the installments, which amounted to a total of 110. So from that year's profit, you take out the installment taxes, and that balance of 790 is what you will pay as balance of tax. And this should be paid by the last day of the 4th month in 2023. So in our case, our December year end, we expect that by the end of April 2023, you shall pay us the remaining 790. And installment taxes are different for people who are involved in agricultural activities. There are 2 installments, and you pay 75% on or before the 20th day of the 9th month, and 25% on or before the 20th day of the last month. Then you also compute your balance of tax, if any, and make that payment by the last day of the 4th month in the following year. So how do you determine taxable income. In our previous or earlier, just a little earlier, we have said you take your income and you deduct what we have as allowable expenses. So here in our first example, we are looking at a company, a limited company. So you have made your gross business income is 3.55 million. Then allowable expenses, that is expenditure which you have wholly and exclusively incurred to produce that 3.55 million. So you have salaries, these are examples of expenses. You have insurance, you have legal fees, rent, electricity. We have wear and tear and fuel expenses. All these expenses amount to 550,000. So from that 3.55 million, you take away the 550,000. And now what we have is the taxable income. So tax will be charged on that 3 million on your taxable income. So in the case of a limited company, tax is usually charged at the rate of 30%. So 30% of our 3 million is what we get as 9 million. So for individuals, okay, I'll take you through because the rates are a bit different from those of a company. So we assume we still have, okay, as an individual, I made that profit of 3 million. So these rates of tax are usually contained in the Act, and if they change, we are notified through the Finance Act or any acts in between. We have some acts that can amend these rates. So currently the rates are for the first 288,000 shillings in a year, they're given per year. It is 10%. And then for the next 100,000, it is 25%. And then any income over and above what we have already taxed at 10 and 25%, that is 388,000, is charged tax at 30%. So for our example of 3 million, the first 288 at 10% will give us that 28,800. Then the next 100,000 at 25% gives us 25,000. And then income, all income over and above, that 388, the 288, it's 100,000, will be charged tax at 30%. So in our case, from 3 million, when we deduct the 388, we are left with 2,612,000. So at 30%, it gives us a total of 783,600,000. So when we add that tax, it comes to a total of 837,400. So for individuals, we have what are called personal reliefs, and they are also given in the Act. You don't guess what personal relief should be. So currently, personal relief is 28,800. That is for all individuals. And then installment taxes. Now, okay, in our examples, we had talked about installment taxes, and we had given an example where you paid 1/10 as installment. So when you come, you have determined that your tax should be 837, but you are allowed to deduct that personal relief, and you also deduct any taxes paid in advance. So it's not just installment taxes. Remember, we talked about withholding tax and we talked about advance tax. So if you had paid any of those, you add that up, you get 138, and you are left with 698. So that is what now you'll be required to pay when you're filing your return. So a summary of the annual tax regime, that you take your actual tax liability, you deduct installment taxes or any other taxes paid in advance. Then when you determine your actual tax liability, you pay the balance of tax, which will be the tax liability minus what was paid in advance. So we have what are called due dates. That is the date by which, or the time period by which we expect you to have done certain things. So in the case of income taxes, the due dates we have are for filing the return and for making payments. So under the turnover tax regime, this is usually done monthly. So we expect you to file your return by 20th of the following month. So that now, if you've been trading the whole of January 2022, we expect that by February 20th, 2022, you will file that return. So if you're late for some reason, maybe, and you file on 21st, then we shall charge what is called a late filing penalty. And that late filing penalty is charged at the rate of 5% or the amount 5% of the amount of tax that is payable, or 1,000 shillings per month. So, for example, in January 2022, the tax that I have computed is 100,000. So I file by return late. I file it on the 23rd of February. So 5% of that 100,000 would be 5,000. So I compare 5,000 to that penalty of 100,000, and what I'll pay as penalty is the higher of the two. And these are set in our systems. They are not amounts that are just given to you. So the system will compute 5% of what is payable, the penalty of 1,000, compare the two, and it will levy the higher penalty. Then under the annual regime, we had said earlier, we expect you to file by the last day of the 6th month after the end of the accounting period. So for individuals, remember, for individuals, we have an accounting date of December. So by 30th June, we expect that you shall have filed your return. If you're late in filing your return, then there's a penalty for that. And that penalty is 5% of the amount of tax payable, or 2,000. So again, we calculate, or the system calculates, 5% of what you have declared and 2,000, and a higher penalty. The higher of the two is what will be levied as penalty. Then we have late payment penalty. So we have our taxes. I'm supposed to pay 100%. I have not paid, so we have late payment penalty, which is 5% of the tax due. So out of that 100,000 that I was to pay, I have not yet paid it, so the system will charge me 500, by the due date. What guides us for late payment is the due date for that payment. Remember, like we had talked about, the 4th day, the 4th month following the end of the year. So if I have not made that payment by then I'll be charged that 5%. So supposing out of that 100,000, I pay maybe 20,000, I'm left with a balance of 10,000. Then we have what we call late payment interest. So that 80,000 will be charged another penalty. And that penalty will be 1% of the unpaid amount. And this 1% is usually calculated starting from the day the tax was due up to when I'll make the payment. So if in February I have not made that payment by the due date, then I'll be charged 1%. And it's 1% per month. Then we have exemptions under the Income Tax Act. The most obvious exemption is that for persons with disabilities. So from that, this is only available to individuals, and it is not automatic that you'll be granted an exemption because of disability. What you're required to do is to make an application for that exemption. So the process starts at the National Council of Persons with Disability. They do have a procedure they'll take you through, including assessment. And once a decision is made that you are disabled and qualify for exemption, then they'll make that application in the system on your behalf. Then when it comes to KRA, we process the exemption and give you a certificate. So when you're filing your return at the end of the year, you will declare that certificate, and that is how we calculate now your taxes. So tax for persons with disability who've been granted that exemption, if you're in employment, it is 150,000 per month of the first. It's not the entire income that is exempt. It is only the first 150,000. Or if you're to translate it for the whole year, it would be 1.8 million per year. So you remember in the example, we had done an example of income of 3 million. So for a person with disability, you take the 3 million, deduct 1.8 million, then that remaining 1.2 million is what you shall subject to tax. Then there was also another exemption. This is within our laws. Okay, the tax exemption for persons with disability is contained in another law, but it is us who operationalize it. So then Ajira Digital Programmer, there is an exemption that is granted under paragraph 58 of the first schedule of our Income Tax Act. And it grants exemption on the income earned by an individual who's registered under the Ajira Digital Program for 3 years, starting from 1st January 2020. And then there are conditions attached to it. So it says you shall qualify for the relief upon payment of the registration fee of 10,000, and also the cabinet secretary. The cabinet secretary in this case is the CS in charge of the treasury. So he shall, in consultation with the CS for the ministry responsible for information for ICT, issue regulations for better carrying out of this provision. So once you have the regulations and you have paid and satisfied all those conditions in the regulations, then you will qualify, and it is on your income for 3 years from 1st January 2020. So, okay, I know this has been very brief, and maybe by the end of the session, we are still not clear on some of the matters that we have discussed. You can seek clarification from us. You can do it in person. You can come to any of our offices. We have offices countrywide. We have Huduma centers. And then you can seek clarification by telephone. We have our contact center, and those are the telephone numbers that you can use to get in touch with us. You can also seek clarification through email. Maybe you're not sure how a particular law is to be applied. So you can do it through the call center or through our policy and tax advisory unit. So we've given both e-bills where you'll raise your issue. If it is a law, you'll also give us your interpretation and provide all the relevant information that will enable us to guide you properly. Or you can even write to us a letter and send it through the post, through the given address, or drop it at 19th floor Times Tower, and then we'll get back to you. We'll give you a written response. Then in case you have come to us and you're really not satisfied with what we have done, then there are other channels that you can also report this, and all these contacts are given. And with that, I will come to the end of the presentation. But before I end that presentation, please allow me to just come back here. We've talked about taxation of the individual and taxation of companies. But I did not include an example of a partnership. But what happens with partnerships, once that taxable income is determined, it is divided to the partners according to the given ratios. The partners will have determined how they will share the profits. So let's say it is me and Kasim in business, and we determine that we shall be sharing these profits 50-50. So my share of income will be 1.5 million, and Kasim's share will be 1.5 million. So each one of us will apply these individual rates. So from my 1.5 million, 288 goes at 10%, 100,000 goes at 25%, and anything above the 388 will be charged at 30%. So it will be 1.5 minus 388,000, then times 30%, get my tax, then qualify. Each one of you as an individual qualifies for personal relief. Then you compute your tax payable and make your payments. And with that, I believe I have come to the end of the presentations.
Thank you, Elizabeth. I think just one thing that is needed for clarification, which was one of the questions, right? You spoke on the digital service tax, right? I think people don't know the difference between a resident and a non-resident. So if you could please clarify on that. I think that was on Kasim's side, right? On the taxes for the digital service tax, which was implemented in 2021, if I'm not wrong. Kasim?
Thank you. You can hear me, Edward?
Yes, I can hear you loud and clear.
Yeah, so thank you for that question. I think it's a good question. Differentiating who is a non-resident and who is a resident. For tax purposes, a resident is someone who is in Kenya and who has a permanent establishment or an office located in Kenya. So that's the first definition. So, for example, if you are trading in Kenya, you must be having a physical shop in Kenya. So the difference between a resident person or an unresident person is an unresident person is trading in Kenya through online platforms, but doesn't have a physical office or doesn't operate a physical shop in Kenya. So that primarily differentiates between a resident person and an unresident person, without going into details of the other issues. I hope that clarifies the issue. For purposes of digital services tax, that definition is sufficient.
Thank you, Kasim. Another question I think that wasn't really clarified is also on VAT, right? You had mentioned that there's VATable, right? Items that ideally have VAT and items that don't have VAT, right? And you had mentioned that on the it's just clarify just that a bit, because you said there's some net tax that you're supposed to pay and the other shouldn't, and then we should close this, right? I think that was the only question that was remaining.
I can't. I didn't get your question.
It was
just come again.
It was the difference between the items that are vatable and the items that were not vatable, right? If you could clarify on the taxes there, and then after that we can close the section.
Okay, so what I indicated is from the VAT Act. There is the first schedule, which indicates exempt goods and exempt services. So for exempt goods and services, you will find them in the VAT Act first schedule. And if you don't find these services in the first schedule, then automatically it's going to be a service or a good that is vatable. So, for example, if you're looking for a service, you go to the first schedule and you find educational services in the VAT first schedule. You will see it under the exempt schedule. So automatically it's going to be an exempt by the fact that it is appearing under the first schedule. So if that service that you're looking for does not appear under the first schedule, either part 1 or part 2, then that service is going to be subject to VAT, and that is what we are saying is vatable. I hope that clarifies your question.
Yep. Thank you, Mohammed. Thank you, Elizabeth. It was really insightful, right? It's a learning curve for both all the vendors here, and also for us as well, to demystify some of these questions on, taxes and everything as an individual and as a company. So we thank you so much for taking your time for this webinar. And I would also like to thank the stakeholders here also at Jumia for being available. So Anne Wanaina, Christine Buru, Shufena Weadsi, and myself, right? We will share this presentation, right, with everybody for the video, for the vendors who can be able to answer the questions, right? In which now, as Credit put on the different, the two topics, right, on VAT and the business income. Okay. I'd like to thank you all, and I'd like to say a vote of thanks to everybody. Thank you.